So preferred shares have two further subtypes. One is called cumulative preferred shares, and the other one is called non-cumulative preferred shares. The difference between the two is that, so let's say a company has $2 100 outstanding cumulative preferred shares, and it also has $2 100 non-cumulative preferred shares. And let's say this is fiscal year 2024, and the company declares no dividends. For 2024, the company chooses not to declare any dividends. And then in 2025, the company chooses again not to declare any dividends. But then in 2026, the company declares the dividends. Declares the dividends means the company says, this year we're going to pay dividends. So what's going to happen in this scenario is the cumulative preferred shareholders are going to get paid a total of $200 for 2024, an additional $200 for 2025, and then a further $200 for 2026. So in total, they're going to get paid $600. Not cumulative, on the other hand, 0 for 2024, 0 for 2025, and then 200 for 2026, and a total of $200. So in a nutshell, the difference between cumulative and non-cumulative preferred shares is that whenever a company declares the dividends and they have not paid dividends in the prior years, they have to pay the cumulative preferred shareholders for those prior years as well. But they do not have to do the same thing for the non-cumulative ones. They only get paid for the year in which the dividends are declared. Another thing that you need to learn in this module is what we call a stock dividend. This is similar to a cash dividend. The difference is, rather than the company paying cash in dividends, the company just pays in stock. They issue more stock. So again, let's say a company had 1,000 common shares outstanding. And the market price for these common shares at this time is, let's say it's $20. So that is market price. And the company declares a 10% stock dividend. So this essentially means that company is going to issue an additional 100 common shares, because they're just going to take 10% of the existing stock. So 10% of 1,000 is 100. And the journal entry will look like this. So debit retained earnings and credit common shares. And the amount will be the additional common shares times what the market price is. So that will be 100 times 20 equals 2,000 and 2,000. And we debited retained earnings because when a company pays dividends, it reduces its retained earnings. And you reduce your retained earnings by debiting it. And common shares are increasing, so you increase common shares by crediting them.